I am coming to you today once again to discuss some very basic topics in managerial accounting. This particular live broadcast is for my current students at San Jacinto College here in Houston, Texas. However, anyone who is viewing is more than welcome to participate and ask questions as they come up. And I did just receive confirmation from someone that they can see and hear me. Great. So now I can not worry about that. All right. So what I plan to do today, my students at San Jacinto College are having their first exam on chapters 13, 14, and 15 in our the current textbook that we use, which is Financial and Managerial Accounting Information for Decisions. And those chapters cover the information that is listed in the info section. However, after we go through some of the basic information of those chapters, then I'll leave time so that you can ask questions if you so desire to. So throughout the process, if you have questions or comments or anything, please feel free to just drop a note into the text box. I will see those and I'll respond accordingly. All right, so without further ado, what we're going to do is just jump right in. Our very first chapter that we talk about covers analysis of financial statements for interested users. So when we're talking about the analysis of financial statements, basically what we're talking about here is the ability to use our financial statements for information. A lot of this chapter, a lot of the information that we cover in this chapter is actually things that people use when they're looking for companies to go and invest in. So when a consumer or a business is looking for a customer or a company to invest in, these are the type of analysis that they'll do in order to make those types of decisions. We want to know how great the company is or how great the company is performing, and we also want to know if the company is maybe not somewhere I would personally want to put my money. So what I did was I'm going through the PowerPoints that are provided for our class and kind of very briefly touching on certain things within those chapters that I thought were relevant. If you have questions, once again, just feel free to type them into the chat box. So the overview of this chapter specifically kind of just talks about those different financial statement analysis. So the idea is that you take financial accounting before you take managerial accounting. And what that does is it's going to provide that foundation. So by the time you get to this chapter, you shouldn't be asking questions about, okay, this is an asset, where should it go? Where are our revenues found? Things like that. No, we've moved past that. Now we're taking those income statements and those balance sheets that we prepared in our first class, and we're using them to take that information a bit further. So what we do here is we're going to take those financial statements and we're going to use them to find more information. The way we do that is typically a lot of ratios. Now, I was an accounting major in college. I loved accounting. I hated finance. This is more of a finance-based chapter. Now, there's some people who love finance, hate accounting, and there's some people who love both, or there's some people who hate both. If you're one of those people who hate both, I'm so sorry, but you still have to go through this. But anyway, so essentially this chapter is actually kind of pretty short and sweet because it's just very heavily formula based. And so what I'm going to do is kind of skip ahead to that slide. Let me just back out of this really quickly and then we'll go to that slide. And what this slide does is it provides a summary of all of the formulas that you may or may not need to use for this chapter. And so from an exam perspective, if you're reviewing for the exam, this slide, which is slide 48 in our PowerPoint, and it's also located in our book, in the back of our book, is very helpful because it lists out all of the formulas, all of the ratios, all of the different calculations that you would be required to do. Now, this chapter is going to go through and ask you and show you how to interpret those formulas and those ratios, but then it kind of becomes a situation of doing the work as opposed to understanding the work. So it's like in algebra. A lot of people in algebra are just like, don't explain it to me. I don't need to know why we have an X here, a Q here, a C here, and all these other numbers. Just show me how to do it. Well, this page, these formulas just show you how to do it. The chapter is going to take you through for those people who are like, I need to know why. Why do we need to do these calculations like this? Why do we do the current ratio versus the quick ratio? Well, the chapter is going to take you through that. So if you have specific questions, please feel free to write them in the chat box. But I'm not actually going to spend a lot of time on this because from an exam perspective, of course, you are able to use your notes. The exam is timed, so you can't draw from it too much. But having something like this will help you, guide you through the information that you're going to need to make the calculations. Just some things to kind of note is when they tell you, like, for example, here, the last one under liquidity and efficiency, the total asset turnover, when they say things like average total assets, then you're going to average the total assets for 2 years. So you should be giving a balance sheet that has information from year 1 and year 2. So you're going to average those two together. So that means add them together, divide them by 2. And that's the number that you're going to use. And for the top part of that equation, when it says net sales, if you're looking at your income statement and it tells you your gross sales and you have some returns and some discounts and all those other things, our net sales is going to be our gross sales minus all of those other little things that have occurred. And I was trying to see if I could take it back to the slide where we had the example. Let's see here. They do give you in this PowerPoint, they show you, so here is where they show you the 2 years that we referred to. So this is our balance sheet here. So you can see that they give you the balance sheet in terms of 2015 and 2014. So if we were looking for our average total assets, then we would need to take these two numbers here. If you can see that, the two numbers for the total assets for 2015 and the total assets for 2014, average those together. That would be that number. And then the other part of it is from the income statement. A lot of times they will show us the information in net sales, but sometimes, just sometimes, they'll try to trick you and they'll give you the gross sales minus this, minus that, whatever the case is. If you ever see that, then you want to make sure that you're looking at the net sales number. All right, so those are kind of the tricks of the trade where that is concerned. All right, and so that's pretty much chapter 13 in a nutshell. I mean, that's pretty much it. Chapter 13, like I said, is really heavily formula based. If you have the formulas sitting in front of you from a calculation standpoint, it's just knowing how to plug the information into the formulas. All right. So with that being said, we're going to move into chapter 14 for us, which is managerial accounting concepts and principles. All right. So managerial accounting concepts and principles are pretty much, we're now about to introduce this whole concept of managerial accounting. All right, so managerial accounting is different from financial accounting because managerial accounting is kind of like an internal form of presenting accounting information. If you remember from your financial accounting class that hopefully you've already taken, financial accounting is very structured. They tell you exactly how you're supposed to report information, exactly what it's supposed to look like, and it's just, there's rules, they are what they are. Managerial accounting, on the other hand, is very kind of flowy. We go with the flow over here. We do what we want to do, kind of. There are certain rules, but because it's internal, I'm preparing these managerial accounting reports for my internal people. It doesn't matter. If you're preparing a report for the sales department, then you can totally make this report tailored to the sales department. They don't need to see what's going on in the production department or the advertising department or anything like that. They just want to see sales. And so in managerial accounting, you have that ability to change your reports and make it just for your intended audience. Financial accounting does not allow you to do that. It does not matter. The sales department, the production department, the advertising department, all of them have to see the same financial statements. All right, so that's kind of the major difference between financial accounting and managerial accounting. This slide that is in our chapter 14 PowerPoint is a really good slide to kind of like show you the difference between the reports. So it starts with who uses these reports. Well, the user of the financial accounting reports are going to be external users, people outside of the confounds of our company, such as our stakeholders, people we owe money to, like our creditors, and then other people who are trying to decide if they're going to invest in our company, or if they are looking for whatever reason. They don't work for our company. We are not, and therefore we're not tailoring our package, our financial statements to them. However, on the other side, in this green, oh gosh, I forgot my colors. In this green column, we list out who the users are for our managerial accounting. Managerial accounting is comprised of our internal folks. That is our internal managers, our internal employees, and anybody within our organizations who need to make decisions. That is why in a managerial accounting setting, we are able to tailor these reports to make our internal people happy. Like I said, our sales department, their job is to go out and get sales for the company. They need to know how well they're doing. They don't need to know their information, which is covered up by the advertising and production and all these other people. They don't need to see all of that. They want to know, how are we doing on sales? Because they are going to be judged on how well the sales department is performing. So managerial accounting allows us to do that, provide them with that information. The other thing that we do is we go through and it shows us who, what the purpose of this information is. We kind of talked through that a lot already. Number three, the flexibility of the reporting. Well, financial accounting has to stick within GAAP. It has to follow the generally accepted accounting principles. There's no questions about it. These go to the federal government. The FASB makes these pronouncements. The SEC has certain rules. All of these things that they're governed by. Whereas the managerial accounting, they have flexibility. Most of their stuff will not be GAAP, because when we're preparing these internal reports, we're not really following any rules. All right, and then you can kind of go ahead and read through the rest of the other things there that are listed on that slide. So with that being said, I was one of those students who loved financial accounting. I liked structure. That was just me. There's a lot of students that I teach now who hated financial accounting, particularly people who are not accounting majors. And so they love managerial accounting. So it really just kind of depends on who you are, how your brain works, and things like that. All right, and so just kind of moving along into this managerial accounting thought process. With managerial accounting, most of the time when we're talking about it in this class, in this setting, we're going to be talking about it in terms of a manufacturer, not a merchandiser. A merchandiser is somebody who buys their, let's say we sell t-shirts. They buy their t-shirts already made and put together. Then they take them and sell them. They don't make anything. Whereas in this class, for managerial accounting purposes, we are talking about a manufacturer. This is a person who buys cotton and thread and whatever it takes to make. I like make it. Let's make cupcakes. Okay, so this is the person who, they're not buying their cupcakes already made and then selling them. They're actually making these cupcakes. So they're buying flour, milk, eggs, butter, all of those yummy ingredients. Oh, sugar, you can't forget the sugar. All of those ingredients that go into making a cupcake. All right, and so what's going to happen is, previously we had one account called inventory. All right, it was just the inventory that we bought and then turned right back around and sold it out the door. Now what's happening is we're buying all of these, what we call raw materials listed here, and we're converting them. We're slowly converting them into work in process, which means we've combined some of those ingredients. So we've put our flour into the the bowl, we've put our milk into the bowl, we've put our eggs, we've put our butter into the bowl, but it's not a cupcake yet, right? Nobody can eat that. We can't sell that. That is work in process. So we are in the process of making these ingredients. However, they're still, random ingredients, right? We can't sell that yet. So that's our work in process. And then our last category is going to be our finished goods. That's when we've baked our cupcakes. Those cupcakes are baked and ready to go. We're ready to sell them. All right. So that's our finished goods category. So what's going to happen is on our balance sheet, we're now going to have 3 separate inventory accounts. We're going to have a raw materials inventory, a work in process inventory, and then a finished goods inventory account. And we need all 3 of those to be separate because in all 3 of those areas, they represent 3 different things, okay? All right, once something has been combined, it's like, think about it. If you put the flour into the bowl with the milk, can you pull the flour back out and separate it from the milk? No, you can't. Okay. So once it's in work in process, it can't go back to raw materials. And once it's been baked as a finished goods, it can't go back to being work in process. So, I mean, if you think about it, it just kind of makes sense, right? It's just the way the process works. All right. And so then it's just showing you here, which let me move my face out of the way. Over here on the balance sheet, it's just showing you how we have these 3 categories: the raw materials inventory, the work in process, and the finished goods inventory. So before in the middle here, we used to have 1 category, the merchandise inventory category, but now we have these 3 different inventory categories. That's all that slide is showing you there. All right. So I am going through this rather quickly because we're covering 3 chapters in hopefully within an hour. So once again, if you have questions, please type them into the chat box. And if you're not able to view this live and you're watching this as a recording, once again, please email me with questions. All right, and this is just showing you the flow of how the inventory moves throughout the process. So what happens is we have that beginning inventory, and this slide is not the one that I really wanted to show you. Some pretty good information in here. So for those of you who do have access to this, I would definitely encourage you to go back and utilize the PowerPoint slides. It's a very great way of summarizing the information. All right, and so this is a slide that I wanted to show you guys. So this is the flow of the information, and it can be a little overwhelming if you look at it kind of like just staring at it. But what's happening here is our goods are coming through. They're starting as raw materials. They're just, like I said, our flour, our sugar, our butter, all of those things that are completely separate entities. Like they haven't been combined or anything. The eggs and the milk and the butter, they're in the refrigerator and we can tell what they are. They are raw materials. They're materials that we have purchased for the sole purpose of making these cupcakes. Then what's going to happen is we're going to add them to production. This is when we're going to start to mix some of those ingredients together. So as we're adding these materials to production, that's when we start talking about the difference between our direct materials and our indirect materials. Our direct materials are those materials that we purchase specifically for these cupcakes. So the flour that we purchase, the eggs, the milk, all of those things. The indirect materials are things that we just kind of have lying around on the shelf because we use them for a few different things. It's kind of like the salt. Yeah, you wouldn't think salt would go into cupcakes, but you have to add just a little pinch, a little dash of salt. And that's not something that we're going to buy specifically to make these cupcakes. So those are going to be indirect materials. We do not purchase those directly for these cupcakes, so they're indirect. And then we have direct labor versus indirect labor. So what happens with direct labor is that factory person that's there mixing up our cupcakes and they're actually putting the ingredients into the bowl. That is our direct labor. They are touching our product. I wish I had a cupcake to just like demonstrate here. But anyway, they're actually touching our products. They're the ones who are physically putting things together. That is direct labor. Our indirect labor is that person's supervisor. The person who's kind of in the back in his office and he's just yelling at the person you're not mixing fast enough. You need to go fast. Whatever the case is, that is the indirect labor. He's not directly associated with putting the products together, our manufacturing our product. And then we have factory overhead. Factory overhead costs are any costs that are associated with getting our cupcakes ready to be sold. That means the building that we're in, any of the factory costs associated with our factory, those are going to be factory overhead costs. Now, the accounting department over in the other building, who's responsible for our billing and all that other stuff, they're not in the factory. So they are not factory overhead costs. All of the electricity and things like that associated with our factory building are factory overhead costs. So the way that I usually explain this to my students is, think of it like this. Does it have anything to do with the factory? Okay, if it has something to do with the factory, then traditionally it's going to be direct materials, direct labor, or factory overhead. Our indirect materials and our indirect labor go into factory overhead because there's only three categories basically. If it's not direct materials, if it's not direct labor, then it has to do with the factory, then it's going to have to go into factory overhead. All right, and so what you'll see, and we'll probably kind of see it a little bit more in the next chapter, is that the indirect materials and the indirect labor, they go into factory overhead first, and then we take it all over to work in process together. And we'll kind of talk about that a little bit later. But anyway, so what happens is we go from our raw materials, then we go into the work in process, then we put our cupcakes in the oven. When they're ready and finished, they go to finished goods. That one's pretty easy, right? Because, I mean, if you think about the words, they just make sense. They're raw ingredients. Then they go into work in process because they're in the process of being baked and ready. And then they go into finished goods because now they're finished. All right, so our goods will sit in finished goods until we sell them. And then what will happen is down here in the bottom right, they will go into cost of goods sold. All right. And so as we're moving our inventory through the process, we're going to take them out of raw materials inventory, put them into work in process inventory. Then we're going to take them out of work in process inventory and put them into finished goods inventory. And of course, that is because we have double entry accounting and we want to make sure we're not double counting this stuff. All right. I think that's a pretty good summary for chapter 14. All right, and so that pretty much sums up what happens in chapter 14. The last thing that I wanted to show you just really quickly is this little table. Not as a table, it's a picture that I created to kind of help with the flow also. So let me see, did we cover that in this chapter? Yeah, I think it is covered in this chapter, where they're kind of they're showing you how all of these numbers go into calculating other things. And I created this graphic for actually my cost accounting students so that they can use this to understand how we use raw materials, how we use work in process, how we use the finished goods inventory, and what how they are affected, how they affect our income statement and our balance sheet. So what happens is if we're trying to get the total amount of direct materials used, we take the beginning raw materials inventory, the stuff that we had at the beginning of the year or the beginning of the period, beginning of the month, whatever. Then we add any purchases. If we purchase some flour, we purchase some more milk, things like that. That gives us the total raw materials available for sale. Then we subtract out anything that we had left over at the end of the period. So we used up some stuff and this is what we had left over. Then that's going to tell us how many of the raw materials, how much of the raw materials we used during this month or during this period. All right. And raw materials and direct materials are pretty much kind of used interchangeably. And so that's why you'll see that we kind of started as using the words raw materials and then we kind of switched over and used direct materials. All right, the next section is the work in process. And so I'm just going to get rid of my face so we can see it. All right, work in process. So the thing that this is trying to illustrate is the fact that we use this language a lot. We use it to go flow through here. And just really quickly, I am kind of skipping over some things. I have a video about cost concepts that helps to explain how these costs kind of interact. I use some old Play-Doh containers to kind of show how direct materials, direct labor, manufacturing overhead, how they kind of flow in and out of these different cost concepts. And so you might want to go and review that, and this will make a little bit more sense. But anyway, so when we're trying to calculate the cost of goods manufactured, so in the first set over here to the left, we were calculating the raw materials. Over here in the middle, we're calculating the cost of goods manufactured. So in order to calculate that, we have to use our beginning work in process inventory. Then we add our total manufacturing cost. Total manufacturing cost, as you can see down here, is a little kind of cheat sheet down here. It tells you that manufacturing cost is equal to direct materials or raw materials plus our direct labor plus all of our manufacturing overhead. All right, so if we didn't know our direct material number, then we just got that from over here to the left. Then we'd have to be giving our direct labor, our direct and our manufacturing overhead as well. All right, and then we can use that to kind of follow that same type of formula that we did over in the direct materials. We take our beginning plus kind of like the purchases, what we added to the pot. That's going to give us this total kind of available, the total cost of work in process. Then we subtract out what we had left over at the end of the period, and that's going to tell us how much we actually manufactured this period. Okay? Then the last piece of the puzzle is we're going to go and we are going to calculate the finished goods. So our finished goods is going to also pull from our cost of goods manufactured that we just calculated. This a lot of times is something that you may see show up on the income statement. So we have our beginning finished goods, then we show what we added to the pot, right? Purchases or total added to the pot. The total that we added here are the goods that we manufactured, the goods that have now come out of work in process and now are being transferred over to our finished goods. That's going to give us our cost of goods available for sale. Then we're going to subtract out our ending finished goods inventory, and that's going to give us the cost of goods manufactured. I'm sorry, not the cost. The cost of goods sold, which cost of goods sold is something that you have seen on the income statement before. So all of this kind of just takes you through the entire process to show you from a manufacturing standpoint how we arrive at that information that is on our balance sheet and our income statement. More so the income statement because we have cost of goods sold. All right. That's a lot of talking. All right, so I have probably talked your ear off and you may be about to pass out from all of this wonderful accounting information that you are taking in. So I just wanted to pause here for a second and just see if there were anything that you guys may still be unclear about. Unfortunately, my handy dandy screen here that I use to kind of tell as far as from feedback is not working. I can see the chat box though, so if you have any questions and would like to add those, please definitely feel free to do that. All right, so I haven't seen anything pop up recently, so I'm going to keep going. The next and final chapter that is going to be covered by my exam for my students is chapter 15, which covers job order costing. Job order costing is usually kind of presented in contrast to process costing, which we actually cover in chapter 16. So it's in a separate unit of information, but it'll be the first chapter that we cover after this exam. So job order costing is basically, let's see, let me pull this up really quickly. All right, and then let me make it so you guys can see it. All right, so job order costing is basically the whole point of managerial accounting in a lot of ways. Managerial accounting and cost accounting kind of go right hand in hand. The reason that is because the whole point of both of these is to kind of develop a costing structure. Because what happens is if we are manufacturing a lot of products, then it is too much work to keep up with exactly what the cost is for each of those products that we're putting into the pie, right? It's too much to say, okay, we made a box of cereal. I wish I had a box of cereal, but I don't. All right, well, let's see. I can use my book here. All right, so this is actually the textbook that we're using, right? In order to manufacture this textbook, we had to come up with the binding, the papers, and all of this stuff that we have inside of the book. The papers, the ink, all of those things that we had to put together to make this book. All right, so this is going to be our example here. So we mass produce a lot of these textbooks, right? We don't just make one textbook at a time. That would take way too much time and too much money. So as opposed to mass producing one, we produce a lot of these textbooks, and we buy just a lot of paper, a lot of the binding materials that we use to put in here. We buy a bunch of ink. We buy all of this stuff and we mass produce it. This is an example of process costing. Process costing is for those companies who mass produce a lot of products at once. Okay, so I always think of like cereal companies. Cereal, like if you buy a box of cereal, most of the time you see that big conveyor belt where they're just like producing a lot of cereal all at once and things like that. We're producing the same thing. All of our cereal boxes look the same. Your box of Cheerios should look like my box of Cheerios. Okay. Job order costing is completely different, because in job order costing, what's happening is these are very unique, very large items, very unique items, and usually they cost a lot more because you're paying for the fact that it's specialized. For example, if I were to go to someone and have my wedding invitations done, my wedding invitations better not look like those wedding invitations that somebody else has, right? I want my product to be specific to my wedding. They're unique. They're my colors. They have the words that match what I'm doing and all that other stuff. That is a job order cost system because it's unique. Another thing that they usually will use it for is if they're building, like, let's say you're building like a plane or something like that, like something so big that you do want to make sure that you're properly costing that thing out, right? You want to keep up with how much did it cost us for these chairs, these seats? How much did it cost us for the metal? I don't know how to make a plane. But anyway, so how much did it cost us to put all of these things together? We want to keep up with those costs because it's gonna cost us a lot of money. So those are gonna be job order costing. All right, and so here we have an example of some job order costing versus the process costing. And so they talk about the fact that it's a lot of the stuff that we already kind of talked about. Under the job order costing, it's going to be custom orders, things that a customer wants specifically tailored to something that they are doing. It's not something that we can mass produce. They're going to usually be different products and services, low production volume. So it's not something that we're mass producing and that we're making a lot of. And then, you know, they have a lot of say in how their products are produced. All right. On the other side, if we're looking at the process costing, it's repetitive. They're making the exact same product over and over and over and over and over again. We're going to produce like 1 million boxes of Cheerios all at once. Okay, so that's process costing. We have our low product flexibility. They don't really have a lot of say. Like I can't say, oh, I want my Cheerio box to look like this. No, you don't get that option. So those are the process. All right, and then kind of going back and including the language that we use from our chapter 14 that we just covered. Here we have a really nice, pretty picture of how the costs flow as far as from a job order costing perspective. So as a review that we kind of just talked about this, our manufacturing costs, which consist of the direct materials, direct labor, and our overhead, we're going to start there, and then we're going to slowly feed in to work in process based off of what they need, based off of what we're making. For job number B15, we're going to say, hey, we need some rubber to make the wheels for job number B15. We're specifically adding things to the order based off of what it is we're making. We're not like making like a mass producing cupcakes where we're saying, hey, just send over 2 tons of flour. We're going to add it to the conveyor belt. No, we're asking for specific things associated with the product that we're putting together. So what happens is we're going to feed in our direct materials directly into work in process. We're going to feed in our direct labor down here at the bottom directly into work in process. Our indirect materials, remember those little kind of like nuts and bolts things that we did not purchase specifically for these jobs, are going to flow into overhead costs. Our indirect labor is also going to flow into overhead costs, and then we're going to put all of those over there together. So the way I like to think about it is kind of like our indirect materials and our indirect labor, they're kind of shy. They don't like to go over to work in process. They want to go over as a group. So our indirect materials, our indirect labor, they like to go over as a group with all the other overhead costs. So while the direct materials and the direct labor, they're kind of bold. They're like, hey, just send me on over to work in process. The indirect materials and the indirect labor, they're kind of like, no, we're kind of shy. We want to go with a partner. We don't want to go by ourselves. So they all kind of gather here at overhead cost first, and then they'll go into work in process. All right, from work in process, as we complete each of these different jobs, we'll send it over to finished goods inventory. And then from there, once we have sold it, it'll go to cost of goods sold. Okay. And I think that was what I wanted to kind of show you there from there. And of course, as always, you have access to my students. You guys have access to these PowerPoints. They are all saved in our online class. But that is pretty much the meat and potatoes, the gist of everything that we do there. We definitely could take it a lot further, but it's a lot of information to cover in 1 hour from 3 different chapters. So I don't want to kind of bombard you with too much information. As I close out, because that's pretty much all I have to show you guys. As I close out, I do want to kind of give you an opportunity to ask any questions if you have any. All right. And so if you do not have any questions, then please feel free to email me if anything comes up, if you think of anything later, and I will be more than happy to answer your question. So without further ado, it does not look like we have any more questions. So what we'll do is we'll go ahead and call it a day, and we will end here. It has been a pleasure. I hope that you learned something from what we had here today. If you have any questions, please always send me a message, and I will see you next time. Bye.